This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall.
Welcome everyone to today's Economy, Culture and Skills Committee meeting. Thank you all for joining us. Today we're here to look closely at the role of community banks, how they play in London's economy, and to consider just how important they are to our city. We'll be exploring how community banks compare to traditional commercial banks and which Londoners and sectors benefit most from their support. We'll also discuss whether there are actions the Mayor or the Government could take to better support community banks here in London. Before we get started, I'd like to remind everyone to please switch their mobile phones to silent mode. Also ask that members and guests position their electronic devices away from their microphones, to adjust their microphones so that they can be heard clearly, and to remember to lift them up from the base if needed. Members of the public are encouraged to follow at London Assembly on various social media platforms, and when using X, please use the hashtag Assembly Economy for this committee. Now, I have a few items of business to cover, and I'm going to ask Committee Clerk Sal Fazal to confirm any apologies for today's meeting.
Thank you, Chair. Apologies for lateness have been received from Assembly Member Ahmed, and in accordance with Standing Order 2.4, with permission from the Chair, Assembly Member Garrett will attend the meeting virtually.
Thank you. And can I ask the committee to note the recommendations set out on item 2 and ask if members have any items of interest to declare? No. And can I ask the committee to confirm the minutes of the meeting held on the 10th of December 2025 as a correct record? Come on. Yes. Thank you. Can I ask the committee to note the completed and ongoing actions arising from previous meetings? Can I ask the committee to note the recent action taken by me under delegated authority following consultation with party group lead members, namely to agree the committee's report, Employment in London After Prison? Agreed. Yeah, good report as well. We now move on to our main item of business, a discussion on community banks. I'd like to welcome our guests in the chamber. We have Matt Bland, who is the Chief Executive Association of British Credit Unions, Ravi Ravindran, who is the Chief Executive of Lewisham and Bromley Credit Union, and Ben West, Head of Business Development, London Mutual Credit Union. And joining us remotely is Dr. Paul Anthony Jones, the Associate Professor in the Social Economy, Liverpool John Moores University. Thank you very much for all of our guests being here. I'm going to ask our first question. It is going to all our guests, so there's a bit of an introductory element to this. But if there is anything that you can say that's slightly different from our other guests, we'll appreciate that. What do you think are the key advantages of community banks in comparison to mainstream banks? So we'll start with Matt, go along, and then we'll go to our guest remotely.
Thanks very much, Chair, and thanks very much for the opportunity to give evidence to you today. So when we talk about community banks in this context, we're talking about credit unions, and a credit union is a financial cooperative, a deposit-taking institution that offers banking services, savings and loans primarily, alongside other financial services like payments, current account banking, insurance and so on. And so when we refer to community banks in our understanding, that generally is a way that some credit unions choose to refer to themselves in their trading identity in order to, be better understood by the public that they seek to serve. But all of those community banks are, registered as credit unions, which are cooperative societies, as I've described. So it's important just to be clear about that. That's our only knowledge of the use of community bank in this country. In other places it may be different, but they're all credit unions here in the UK and in London too. Yeah, we provide a range of services. We're often associated with financial inclusion, so providing services to those that struggle to access mainstream banking and other financial services. But that's not all that we're about, and around the world, credit unions are a much more prominent part of the financial services landscape. It's our ambition to emulate that here in the UK, and so part of that would be becoming much more mainstream in how we're perceived and the services that we offer. So I'll pause there and let the others maybe add to that.
Thank you, Chair. Yeah, basically, from a personal point of view, Lewisham and Bromley, we only serve the two boroughs of Lewisham and Bromley. So that basically is the community that we serve. Currently, we also recently been merged with another credit union in the region, so we also serve NHS employees and Lewisham Council employees as well. The main difference, I would say, is much more personal service, because a lot of people we actually see are very vulnerable and needy, maybe technically challenged and, educationally challenged maybe as well, and may have other issues health issues and mental health issues. So we are much more friendly face, much more welcoming, much more accommodating compared to other banks who've kind of packed up and gone, branches are closing. Compared to them, we have 4 branches in the region. So I think that's the main difference to help the community.
I think I'd add to that, and I won't go on too much about the kind of the ownership structure, but I think it is important to highlight that as member-owned mutuals and cooperatives, we are owned and run by our members on a not-for-profit basis. So any money that we make doesn't go into shareholders' pockets or into CEO salaries or so on. It's reinvested in our services or returned directly into the communities we serve. And I think the other aspect of that mutuality that's really important is that it dictates the interests of who we're running. We are run for the benefit of our community, and that means that ownership structure ensures that everything that we do is there to improve the financial well-being of the communities that we serve, as I say, rather than having that profit motive. And I think as Ravi's touched on, I think that changes the dynamic and the relationship with our members, because actually they aren't just customers where we're making a financial transaction or selling financial products. They are members, they're part of a community. We've got members who have been with us for 20 years who have been on the journey from coming to us in a crisis where they needed to borrow in an emergency through to a stage where we have one member where she tells us she's got three sons who have been through medical school, and she came to us as a single mum that was struggling with an emergency loan 15 or 20 years ago. Through us, she's gone on that journey from being a borrower into a habitual saver with financial resilience and options. And that's the journey that credit unions like ours can take people on over the long term, is building financial resilience and putting money back into the pockets of local people. And I think that's the real powerful story that often gets hidden behind the sort of the labels of credit union or community bank or whatever you want to call them. These are engines for economic equality within their local communities.
Thank you. And Paul, online.
Okay, thank you, yes. I think I should add really that I am an academic at Liverpool John Moores University, but I also a practitioner on the board of directors of our credit union in Liverpool, which is called Enterprise Credit Union. And I can see the difference between our credit union as a cooperative financial service and banks every day. I think one thing is, it's summed up really in one of the international mottos of the credit union movement, that we're not for profit, we're not for charity either, but we're here for service, and service for our members, and our members in communities. And I think one of the differences is that, as in my own credit union, many credit unions are embedded in communities. They're part of communities. They're part of social and community networks, and can actually engage and reach out to people, in multiple different backgrounds. We have a strong focus on reaching out to the financially vulnerable, the financially excluded, and so on. But we're there for everybody, and we're there for most people, for people on moderate and low incomes, and I can see that in my own credit union. The membership focus is important, and the ownership focus is important, because our credit union, who owns our credit union? The members own our credit union, and we're there only for them. And the products and services that we have to deliver have to meet their needs.
Thank you. Thank you so much. Yeah, that was really interesting, and really comes across strongly that element of trust that there is between the banks and the members and the community, which is I'm hearing that loud and clear. Assembly Member Georgie.
Thank you, Chair. So this is for Paul and to Matt. To what extent, and I feel like you've both, many of the panelists have kind of answered this already, but if there's anything further you wanted to add. So what extent is financial exclusion, such as people not being able to access loans and savings accounts, a problem in London and the UK? I'll start with Matt, and then we'll go to Paul.
Yeah, so it's a significant problem across the UK. So we have estimates from Fair for All Finance, which is an organisation established by government to invest in financial inclusion initiatives, including credit unions, that there are 20 million people across the UK facing financial vulnerability of some kind, and the Money and Pension Service, another government body, has estimated that there are as many as 1 in 4 working age adults with less than £100 in savings. You know, so the financial precarity that implies, and the sense of crisis, just at the unexpected expenses that come along with for all of us in everyday life, impacts on people's mental health and well-being, productivity at work, and so on. So without that resilience that a little bit of savings provides, your only recourse is to borrow in the event that an expense comes along that you're unable to meet. And of course, not everyone's able to access borrowing fairly, and so on. And there are some concerning estimates also from Fair for All Finance around the levels of illegal lending that goes on still within the country. In terms of London specifically, in preparation for the session, we did a bit of research around data that's available, and we can share some of that in writing afterwards. But more or less on every measure, if we take the city, Greater London in total, more or less every measure, we found that Londoners are generally more financially vulnerable and excluded than the average across the whole of the country. Of course, there are huge disparities within the city because of the inequalities that you'll be very familiar with as Assembly members, of course. But that was quite stark, I think, in the reading that we did to look at London specifically, that more or less every measure of financial exclusion and vulnerability was worse for Londoners on average.
Thank you, Matt. Paul?
Yeah, and I would support what Matt said. Of course, we have the statistics, which Matt has been looking at, but also there is the personal experience. And I think it's the personal experience of many of our credit union people in London and around the country that actually demonstrates clearly the need, the financial vulnerability and the financial exclusion in communities. Each and every day, people come to credit unions, looking for affordable credit, other financial services. And in a sense that the value of a credit union is that we can take people on a journey. We can take people on a journey through a process of engagement, of encouraging people to save, encouraging people to borrow responsibly. We can take people on a journey into financial health and stability. And I think this is a massive problem in the country. The statistics show it, but the personal experience in communities reveals it highlights it in big lights that this is a big issue, and this is a key area for credit unions to tackle financial exclusion and financial vulnerability.
Thank you. Ben, was there something you wanted to add?
Yeah, just to add, I think there's an important nuance here which is specific to London, which is that a good chunk, I think, as the other speakers have spoken about, a good chunk of that lending is to people on the lowest incomes, unemployed, facing multiple kind of characteristics of vulnerability. But I guess there is also the other important aspect of financial exclusion here in London, which is those higher and moderate paid people. So 20% of our borrowers are earning over 50k, and those loans are disproportionately to people. Those are disproportionately debt consolidation loans, so people who have bitten off more than they can chew on credit cards, living in their overdraft, perhaps losing their job or a rent increase or an unexpected bill. And I think what's a really important part of the picture here is when we talk about credit unions that we're not just focusing on the most financially excluded, on those on the lowest incomes, because actually in a city where housing and living costs are as high as this, there's a lot of people on moderate incomes as well who are in very financially precarious circumstances, and where one financial shock can push them over the edge from being on moderate incomes, relatively secure circumstances, into situations where they do end up in the category of the most financially vulnerable. And so I think that's a really important part of the picture and an important part of the work that credit unions do in London.
Thank you for that. And Matt, in terms of obviously the organisations that you represent, let's say I come along, my pay packet hasn't covered my monthly outgoings, I'm in real trouble. I don't want to go to one of those cowboy payday lenders, insofar that they still exist anymore. Obviously, you're not a charity, right? So you have to do very quick credit checks on people. How likely are they able to pay? You know, are you going to get a return on that loan? So let's say in that emergency circumstance, just very briefly, what are the rates that generally your, I don't want to say clients, your members offer? And, you know, is it that much better than, let's say, going to the Cowboys? I assume the answer is yes, but, you know, how much better is it? I'm giving you a free hit here. Tell us how great you are.
I appreciate it. Thank you. Our credit unions are restricted in their interest rate that they can charge by law to 42.6% APR, which you know, many of the loans credit unions make are much lower than that. You know, the kinds of scenario that Ben just described. But if you're talking about, you know, the kind of crisis loan that you described there, you know, of a few £100, then, you know, they might be approaching that or at that level. But if you compare that to the interest rates that high-cost lenders charge, it's significantly cheaper. And we're the only lenders in the market that would lend as little as £50 for you know, at that level of interest. And credit unions will do everything they can to help. I mean, I think it's important to say that, you know, just as you've mentioned, we're not charities, and we shouldn't be seen as a solution to some of the problems that are created by, you know, people having, you know, expenses that exceed their income. You know, we can't sustainably or ethically, or indeed from a regulatory perspective, lend to people who can't afford to repay. And so we're not a solution to some of those extremes of exclusion and poverty that we do come across, of course. So we'll have to refer people on to other kinds of help where a loan wouldn't be appropriate or responsible. That's not to say we wouldn't try and help as many people as we can, of course. And it's the cheapest option that people would have in that circumstance in the market.
That's very helpful. And Matt, just one more time, how effective are community banks at supporting financially excluding people in comparison to mainstream banks? And I feel like you've addressed half of it, but I guess I'll just add a caveat to that question then. You know, I guess speed is obviously an element, as you've already outlined. You know, obviously you're willing to help people that mainstream banks just can't be bothered with, or don't see that, you know, they're going to get a return on their loan. You know, so anything in addition to that, how are you different from mainstream banks?
Well, in terms of the, you know, the simple level of lending that credit unions would do relative to banks, I mean, most mainstream banks wouldn't make a personal loan for less than £3,000 or £4,000 these days. So they do, of course, lend to people quite extensively with credit cards and overdrafts in those circumstances, as Ben described. But the problem with those products is that they trap people in debt. You know, if you pay a minimum payment, all you're essentially doing is paying interest to the lender on an ongoing basis, and it's not a sustainable way to borrow. And we still see, you know, levels of problematic borrowing with credit cards and other revolving credit products quite extensively, despite efforts that the regulators made to address some of those persistent debt problems. But I think fundamentally it's about the ethos and the care that credit unions have for their members, as we've all described already, that flows from our membership and ownership structure as a cooperative. We want to support our members rather than profit from them and exploit them. And I think, you know, you have to question whether that kind of persistent debt with credit cards, for instance, you know, which is ongoing in the mainstream banking sector, you know, there could be things that could be done about that by the banks, but you know, they aren't done, and you have to wonder why that is. Credit unions take a different approach because we're member-owned. We're focused on supporting our members to build resilience over time, reduce their borrowing, and build savings, and so on. So fundamentally, it's a different approach that's ingrained in our organisational structure and culture.
Thank you, Chair.
Assembly Member Wilson.
Thank you. Just following on from your discussion with Assembly Member Gogi, you mentioned the cap on the rate. Now, 3% a month doesn't sound very much. Obviously, you annualise that, and it sounds a lot more. But is the kind of overall sort of pattern of your loans and your more geared up towards sort of short-term loans, or do a lot of your clients have longer-term loans that obviously pay back over a longer period and therefore attracting more interest?
Well, the others maybe want to add to this, but I mean, it's a range, and as we've already tried to explain, I think that credit unions can't only serve those that are the excluded, and we want to be service for the whole of the community. And indeed, Ben's Credit Union London Mutual just recently began offering mortgage loans. So that's of course a very different proposition, and certainly wouldn't be anywhere approaching the interest rate that you mentioned. So it's about having a balance, and that's important, diversifying the range of lending that credit unions do to support their sustainability. But for very small loans over short terms, yes, the interest rates, the headline rate is higher, but actually in absolute terms, it's not a huge amount of money that's being charged for considering that the effort that goes into underwriting any loan is to some extent fixed regardless of the value, if that makes sense. I don't know if the others would add to that.
I mean, just an average, about 15% is our rate across the board. Yeah. So from 3% for a new journey, a new arrival, for example, who's on benefits, we have to assess them because at the end of the day, we are lending members money to them. So we've got to be careful that's affordable and they can pay back. I mean, out of 100 loans we give out, 5 of them don't pay back. So we've got to adjust our rates to accommodate for that. And so, yeah, 15%, and the lowest rate is probably about 6.2, and the highest is at 42.6, as you said already.
I think an important bit of context here is that the high cost interest cap is 0.8% per day. So you can imagine how that compounds. It compounds to something like 1,200%. In lots of circumstances, that will be the rate that some of our borrowers are getting. We did some social impact analysis where we looked at each of our loans individually and we calculated how much interest they paid over the lifetime of that loan versus what they would have paid with an equivalent lender. And we found out that it averaged around £350 per borrower. So that's £350 saved in interest on average for each loan. Obviously, for those, we found that on those smaller, higher interest loans, actually the saving was higher because the alternative was also much higher. I think the other important bit of context in terms of what makes credit unions different is 97% of our borrowers save. So 97% are saving at the same time as they're repaying the loan, and so after they get to the end of repaying that first loan, they've built a pot of savings. And so the idea is that rather than loans being a trap to attract somebody in a cycle of borrowing, they're a ladder and they're a way out. So you borrow £500 from us over the course of that loan, maybe you build up a pot of £100 or £200 saving, and you can see how over time it becomes a ladder and a way out of that cycle of habitual high-cost borrowing.
I think, Paul, you had your hand up, but do you want to contribute?
Yeah, just to add a little bit there. One of the basic principles, I think, one of the principles that I learnt about credit union years ago is that credit unions are here to give our members, all our members, from whichever background, a better deal on financial services. They must give our members a better deal on financial services. And of course, that means that loan diversification and charging different rates on different loans is really important and central to the way credit unions operate. So we might charge 3% a month on a £100 loan, but if it's a £10,000 loan, that's just not feasible, and it's a lot lower. And I think the one thing when we're talking about APR rates and the costs, and even 42% seems high to a lot of people, what's more important is to look at the total cost of credit. How much it's really costing people. And when we look at how much it's costing somebody to borrow £200 over 30 weeks, for example, the amount is very small. Even though the APR rate sounds high, it's small. And I think we have to keep those things in context.
Assemblymember Clark.
Yeah, thank you. It's been really interesting to hear about the different approaches and mainstream banks, and thank you all so far. Generally speaking, it seems like a lot of the work you're doing is working with people who are quite financially vulnerable to build their credit and also to get out of debt and then be financially secure going forward. To what extent are you working, and I suppose this is more for Ravi and Ben, but to what extent are you working with local organizations, local charities, people who are already working with financially vulnerable or just vulnerable people? What are your connections with them? Ben, do you want to go first, and then I'll come to you, Ravi.
So as you imagine, there is a lot of overlap between a lot of our kind of community-based members and people in contact with local services. We have a dedicated wellbeing officer who is there to provide that personalised service. For anybody that's in financial difficulty, whether they've got a loan with us or not, they can book an appointment with that financial wellbeing officer. And we are set up and we have established relationships there with local services, so we can signpost to, as you can imagine, gambling is a crisis in our community. It's one of the key reasons why we have to turn down applications for loans, is because we see pages and pages of gambling transactions in people's bank statements when we underwrite the loan. But then obviously there are also more complex needs. We see a lot of financial abuse. We see people with very complex multiple needs. And I think that again, to return back to the question of how we differ from banks, I don't know whether you've been in a local bank branch recently, but even if you're what I would say, someone such as myself, relatively capable, it's very hard to have a conversation with someone even in a bank branch these days. We're increasingly doing the heavy lifting in the community in terms of dealing with those customers who are too expensive and not worthwhile for the big banks to deal with, and it's credit unions like ours that are picking up the pieces there, and providing that bridge between people's immediate day-to-day financial needs and connecting them with the services that they need in order to support their longer-term needs. I guess I would also add to the question around partnerships would be our relationships with employers, because I think that's a really important part of it. A good chunk of our membership and an even bigger chunk of our lending is to people working in the NHS, local authorities, Transport for London. We're lucky enough to have as one of our partners, and I think we're a really important part there of their employee well-being provision, because actually we know that financial stress at work, financial issues can be a cause of all kinds of problems in terms of employee financial well-being. We know the country's facing a productivity crisis and all the rest of it, and so a credit union, by being there as part of the provision for employees who might be under financial stress, but then also being a partner to those employees in terms of providing financial guidance and training and support within the workplace. We're a really important part of the offer there, and actually a very popular employee benefit as well.
And Ravi, just specifically in Bromley and Lewisham, do you get referrals in from, I don't know, Citizens Advice or such places as well?
So most of our we have a relationship with both the boroughs, the councils, and also local charities. One of the main problems within Lewisham and Bromley is eviction because of not paying their rent. And so we have, with both Lewisham and Bromley, something called a homeless prevention fund, which they have given us some of money to support people who are in arrears. And what we do is lend them the money to them to pay the landlord off. Normally it's a social landlord or maybe a private landlord. And then we collect the money over a period of time, which is guaranteed by the council. So over the last 15 years, we've helped about 525 people in that area. Otherwise, they would have lost their house. And the infrastructure they have, children would have left schools and moved around and things like that. And we also have a relationship with a couple of charities within, like Bromley Homeless, for example. They refer people to us and we work with them closely. And in Lewisham, we have Community Action Works as a charity, which we refer people to if we are unable to help them with, they're kind of maxed out on their credit or whatever. We can't help them. We refer to them to go to support. And in some cases, we also work with another charity called Deptford First, which has given us some funds to help with people who we can't lend to. So it's kind of 50 quid. Something like that, because somebody calls in desperate, I need some milk or nappies or whatever, and they're kind of, we can't lend anymore because affordability is key for lending. And if they're maxed out on those, we won't be able to do it. So we give them the money because supported by a charity. So we do closely work with quite a lot of area.
And just, Ben, it was really good to hear specifically about your wellbeing officer. So anyone could just book an appointment with a financial wellbeing officer?
Any of our members, yes.
Yeah. Amazing. Okay. Thank you. Thank you, Chair.
Assembly Member Georgie.
Thank you. Ravi, of that, was it 525? What's the default rate been on those?
I think about 13 people have failed to pay us over time.
So that's a pretty good record.
But there's been greater failure, but we've been collecting money over time.
Yeah, don't worry, I'm sympathetic to what you're saying. I mean, I think it's great. And I think the council acting, is it both Lewisham and Bromley councils acting as the guarantors? Okay, that's very interesting. And
that's been rolled out across the country.
Yeah.
We started it with Lewisham 15 years ago, and there are other boroughs and other communities like Bradford, for example, using that example. And Brent, I think, using it as well. So there are other people who are kind of using that.
Okay, that's fine. Thank you. Thank you, Chair.
Member Desai.
Thank you, Chair. Good morning. So 2 questions to ask both Ravi and Matt. First question is, to what extent are Londoners aware of the products and services offered by community banks in the city?
So there was some research done. I mentioned Fair for All Finance earlier. It's this national body that's given this responsibility around financial inclusion. And they've done some research around awareness levels of credit unions across the country. And so we were able to dig out some of the numbers in London. And it's between about 5 and 8% of the population reports being aware of a credit union in a sample of London boroughs that we looked at. So, of course, that's an issue that we have, and that's not dissimilar to elsewhere in the country in terms of levels of awareness of what credit unions can do and that they're available. And that's a challenge that, we recognise that we need to address. How do we better reach the people that need the services we're offering? And there's a whole range of different things that we could do around that, including potentially working with the Mayor's office and the London local authorities and so on to help promote what credit unions can do. And we'd love to explore the opportunities to do that. Another area is in terms of online lending. So, we know that there are many thousands, if not millions of people annually across the country, here in London no different, looking for credit online and receiving no affordable offers at all, currently through, marketplaces that you'd be familiar with, ClearScore as an example. And we're really keen to ensure that credit unions have access to those facilities so that we can offer credit union lending in the places we know people are already looking for credit online, as well as the in-person community services that we've described already.
Ravi.
So in Lewisham and Bromley we have 4 branches, visible locations, prominent places. Population of Lewisham and Bromley together 600,000. Our membership is 15,000. So penetration level is about 2%, which is very disappointing, obviously. I mean, people are aware, but the engagement, for whatever reason, has been very, very poor. I think that's kind of historically across the board, across the country, credit unions in the UK struggle to get that level, 5% or 6%, 8% or whatever it is, compared to something like Ireland, 60% penetration level. So it's sad. I think, we that help the community, and they're not engaging. Not all of them are engaging with us. And it's a two-way process. You could save, put some money with us, which we can recycle within the community. So, for example, if you're a rich, has some savings, you could invest with the credit union, and that would be transferred into a loan to somebody else. Mm-hmm. So, the recycling the money. That's not. It happens, but not to a great deal.
So, which begs the question: so, what are you doing to increase the awareness of your work? Are there specific campaigns or?
Yeah, we promote. We hold outreach events, right. Leafletting, work with partner organisations. We're constrained by funding, obviously. Yeah. We are limited by resources, so we can only do what we can within that limit. But we are present online. We have an app. So there's no barrier to entry here, but it's difficult to get across to people because, you have various financial organizations with high budgets, promoting their aware every day, in and out, television and radio, etc. You can't compete with that.
Sorry, Ben?
Just to add that I think there is a barrier in terms of awareness, but I think also in terms of perception. I think that amongst a substantial portion of the UK population, if you ask them what is a credit union, there would be some low-level awareness, but there would be a perception that it's not for people like them. It's for I think a lot of the work and a lot of communication around what the credit unions do has been really important, but I think one of the risks and pitfalls in that is that we've ended up with the perception that a credit union is just for the poorest and the most financially excluded, akin to a food bank. And I think if we look at the comparisons of Ireland and the US, where these are established, widely understood parts of the mainstream financial services landscape, I think that's where the biggest barrier needs to be bridged. And so at London Mutual, we work very hard to make it clear that yes, we're here for the most vulnerable in our community, but actually we've also got a lot of value to offer to everyone else as well, and we serve the whole community, not just the least well off. And so through digital advertising, Google, Facebook ads, like lots of credit unions, we're working on getting on the price comparison websites. Our aim is to have a proposition that works for everyone, not just a narrow section of the community.
Thank you for that. If I can come back to you, Matt. So we live in an age of digital banking. So to what extent have community banks been able to upgrade their IT systems?
So I think, broadly speaking, over the last decade or two, credit unions have made great strides forward in terms of their digital offering. So as Ravi said, every credit union, or most at least, certainly the most prominent and well-established credit unions have online banking, banking apps, the ability to apply remotely and all of those things. And that's commonplace. I wouldn't suggest that we're, as digitally advanced as some of the neobanks and others, and we recognise there's always more to do. But we've made great strides in that regard. And I think one of the challenges with that, like with the awareness and marketing challenge, though, is about scale. So the credit unions need a certain level of institutional scale to have the capacity to invest in the digital offering, to invest in their marketing, and so on. And so that's something that we're encouraging through a national growth plan we published just last week. There's a financial inclusion strategy that Treasury published in November, a commitment to invest £30 million in credit union transformation, and supporting credit unions where it's appropriate to combine and consolidate, as well as investing in what we know as credit union service organisations, or CUSOs, which are secondary joint ventures between credit unions to invest collectively in, for instance, digital technology or new products and services, or indeed potentially marketing and awareness raising, is one of the opportunities we think there is to gain that scale, so that we can have the levels of investment we need per credit union in order to meet those needs, both digitally and from a marketing perspective. One thing I'd mention just in relation to the financial inclusion strategy also is the common bond. So we haven't really got into that yet, but this is specific to credit unions. It determines who can join a credit union. So it's field of membership test. You have to be eligible in order to join. And there's actually an apocryphal story about this being created by American bankers to hamstring the competition. Now, I couldn't say if that's true or not, but it's an essential part of what credit union structure is. And currently there's a ceiling of 3 million people at the potential membership kind of footprint that you can have as part of your common bond. And in a city like London, of course, that's a problem, because you can't cover the whole of the city. You can only cover certain boroughs, and so you might be on the wrong side of the road. You can't access the service that one of your neighbours can, just by kind of happenstance. And so we think that raising that to 10 million, we believe Treasury is supportive of that, that principle would allow for a credit union like those represented today to cover the whole of the city, and so any Londoner, regardless of where they are, could access the service. And so trying to remove some of those peculiarities and barriers that there are to people just accessing the service, that if they choose to, is part of the story as well.
Yeah, no, I mean, I agree with what Matt said already. Yeah, I mean, support from government and assemblies like yours to promote credit union across the board would be really helpful to us to increase our membership and sustainability for credit union, because very often the credit unions struggle and fold for whatever reason, and it's important that we are able to kind of maintain credit union presence across the country, either through mergers or to sustainability increase membership.
I think you mentioned the mayor earlier, or the mayor's office. I mean, do you have any sort of liaison with the deputy business mayor, for instance, in terms of helping to promote your work?
Well, I don't know if my colleagues have had. We haven't had any engagement recently, but we'd love to.
Yeah.
I think in terms of the promotion question, there are opportunities, of course. Two obvious ones in terms of the TfL estate. There are opportunities to promote what credit unions do there. I'm sure there are plenty of other good causes seeking that space. We're not naive about that, but it's one opportunity to raise awareness of what credit unions can do for Londoners. Another that Ben's alluded to already is around payroll savings and the role of employers. I know that there's an initiative around good employment in the city, and financial well-being, payroll savings, the role of credit unions in workplaces should be a prominent part of that agenda. And there's some really interesting evidence emerging around something called auto-enrolment or opt-out payroll savings, so akin to auto-enrolment in pensions, which of course has transformed rates of pension savings nationally in the last decade from very low levels to now, most people saving for a pension, which is great. The same principles applies to payroll savings and savings in general. It's not that people can't save in many cases, it's that there are all sorts of behavioural barriers, inertia and so on that prevents people from taking that step to open an account and get into the habit. So if you just remove that barrier by flipping the default and automatically enrolling people into a savings account, which they can opt out of if they wish to, we've seen in a couple of trials, one involving a credit union up in Sheffield, that it's transformational in terms of the levels of saving, and it's very well liked even amongst those people that don't choose to do it. So you're talking about maybe 5 or 10% of employees typically would opt in to a payroll savings scheme like those that the colleagues here offer, and most credit unions do with local employers, where they have to take a step to open an account. That goes to 40 or 50% of people participating when you automatically enrol them. So it's potentially transformational in terms of the levels of saving. I mentioned already the national savings crisis. We've got 1 in 4 working age adults with not even £100 set aside. So if we could pioneer an approach to that in London, I think that would be a very significant contribution, not just to the financial resilience of Londoners, but to the country overall. And I think that's something that the Mayor could potentially champion.
Thank you.
Assembly Member Wilson. Yeah.
Jumping in again, as you talked quite a bit there about savings, just interested to understand what kind of rates do savers with credit unions get, and how does that compare to, just put money in the bank, you get nothing really. It's just there, doing the bank's work rather than doing anything for you. So how does that compare with credit unions?
I mean, it varies. So credit unions typically offer a dividend, which is a sort of retrospective return. In effect, it's an interest rate, but it's not guaranteed up front. Increasingly, credit unions, certainly in more recent times with interest rates rising as they have, are moving into offering fixed rates that are kind of guaranteed up front. But it varies. I mean, the guys here could talk about their rates. I mean, the best performing credit unions are offering very competitive rates of interest, certainly those that focus on workplaces. So we've talked, there are 19 credit unions serving the communities of London, but there are many more national credit unions offering services to employment groups or sectors, the police, for example, passenger transport as another, that would have Londoners amongst their membership. I ran a credit union in the retail sector until last year, and we had members in London as well as everywhere else in the UK. You know, and we were offering competitive rates of interest. That credit union was offering a regular savings proposition, paying 4% interest. So, yeah, you know, but it's important also to say, I think, that it's not just about rates, especially if we're talking about those people who are trying to get into a savings habit. It's more about habit forming than it is about rates. You know, 4%, 3%, 1% on a modest sum of interest of money is not what's driving people to save. It's about getting them into good habits around saving, showing people who maybe haven't saved before that they can actually save, and even small sums of money can have transformational effects on people's levels of well-being, you know, disproportionate to the value of money concerned. And Paul could talk to that. He's got his hand up there. Paul's a guru on the research around that, so I'll maybe hand to him.
Paul, do you want to come in?
Yeah, and it was exactly on that point, Matt, that I wanted to come in on, really just talking about the importance of saving. And our organisations are called credit unions, and people think about them as loan providers. But essentially, at the very beginning in the 19th century, we're there to promote thrift. And the reason for thrift was that saving actually there's a lot of research in this area about saving has got much more value, much more importance in people's lives than just stored income. And saving stores your income, of course, for all sorts of good reasons. But it has a lot of social and psychological impact on people. I've known people in my own credit union who've never saved in their lives before. And for the first time ever, they've saved. And what does that mean? It doesn't mean that they've just got £100 in their account. It means they feel differently about themselves. They feel more stable. They feel more, you know, they feel more encouraged about their future. So saving has got big consequences, and it's so important for people's social, mental and psychological well-being, and that's really important. I think also, just to add another point about return on savings, this is a big issue for credit unions. Credit unions, you know, as Ravi said, we do need people to invest their money in the credit union, but we really need, as I said before, credit unions are there to give people a better deal on their financial services, whoever they are. So we need to give a good return on savings. It's a challenge for credit unions. There's all sorts of reasons why it's a challenge. But now in my credit union, we'll give 4% return on savings, which matches the competition. And we've introduced, as Matt says, we've introduced interest-bearing accounts over and above the dividends that we provide. So I think that's really important. But one last point is that in my own credit union, we did our senior finance officer did some research about the importance of the rate. What he found was that members saving less than £2,000, small savers, really were not rate sensitive at all. But people saving higher than £2,000 were more rate sensitive. So that's something to take into account, that, as Matt said, the value of saving goes beyond the rate, particularly for people on lower incomes saving smaller amounts.
So to answer your question, last year we paid 3% for junior savers and 1.5% for adults. So we encourage junior savers because we are in about 8 schools at the moment. We used to be in 25 schools before COVID, but we are now reduced to 8 schools where we run savings clubs. And we've got about 1,500 junior members. We encourage junior savings, and, you know, kind of if you start young, you're going to build up and the membership will grow. And so that's why we encourage 3%, we offer 3%. And the 1.5% is because year before we had a merger with a local credit union, and that kind of a difficult year for us. So for the last 20-odd years, every year we've been distributing dividends without fail. So that's kind of, you as an adult, you're not here with us because you want to get a return on your savings, really. Because
that's really interesting. Assembly Member Garrett.
Morning, everyone. It's quite interesting, particularly that point about encouraging thrift, which I think is a forgotten important virtue. We've spoken a lot about, in fact, entirely about individuals saving or borrowing through sort of these schemes. Is there any involvement with small businesses? Obviously, that's another group of people potentially who might feel cut off from standard banking or might struggle to get a loan. Is there anything in the sector that supports those kinds of potential borrowers?
I'm going to take that if that's okay, largely because I don't think there are many examples here in London. It's an emerging area for the sector nationally. But there are some examples, one in Greater Manchester I'm familiar with, where a combination of organisations have come together to support credit unions to extend credit to social enterprises in the city. That involves the provision of some guarantees to support the credit unions with the risk, because this is a new area for them, and with support with making those decisions. But we do think there's opportunity to expand what's been done there. So the British Business Bank has allocated funding to guarantee lending to small businesses. And some of our colleagues in what's known as the CDFI sector have interest in partnering with credit unions to support. They have the expertise in lending, but they have a challenge around the funding to support that lending. We have funding available, but don't have the expertise. So there's a potential partnership there that we're exploring, expanding based on this example in Greater Manchester, which could be, looked at for replication here in London, I think, potentially. But it is only, it should be clear, it's an emerging area of work for credit unions, generally speaking, and we are, as a sector, by and large, focused on individual households.
Yeah. Is there a difference to the type of business? Because you mentioned social enterprise there. Is there a difference in the kind of businesses or kind of individuals that you think you might look at differently from a normal bank, or is it just be looking at the same people in the same way?
I think just for the same reasons that credit unions support communities, because they understand their members, they understand the people they're seeking to support in a way that remote large organisations don't. I think we have the same potential in supporting businesses. I should say that quite a lot of what credit unions would do in terms of lending is productive, but focused on individuals. There was a great TV show actually maybe 5 or 10 years ago called The Matter of Life and Debt, which focused on credit union activities across the country, some examples here in London. And there were lots of stories told on that show about loans that credit unions were making to individuals who wanted to set up a small sole trader operation. The one that sticks in my mind, I mean, just because it was nice, was this chap who was buying and renovating an ice cream van, and he wanted that to be his business. But that kind of thing is quite commonplace. That's not lending to a business; it's lending to an individual to set up a productive enterprise, and that happens quite commonly. I think when we think about business lending, it's lending to corporate entities that are registered as businesses, which is obviously a different thing. So I think in that regard, there's lots of what credit unions do is about lending to people to, get on in life, create a small business for themselves, and many of them may go on to be incorporated as businesses in time. They've got to start somewhere as a sole trader in any industry, of course.
Did I see Paul's hand go up? I thought I saw it go up and then possibly go down
Paul would
again.
like to come in. Yeah.
You did, but then Matt stole my point, which is what I was going to say, that when we talk about business lending, there is a distinction to be made between lending to individuals for a productive purpose, for starting up as a small trader, and also lending specifically to the corporate entity, the business. In the Republic of Ireland, it's interesting that they have to report on enterprise lending, which includes the lending to individuals for productive business purposes. I know in my own credit union, I could tell you stories about people who've borrowed money to set up a little shop or buy a van and that kind of thing, but we don't collect the data. So, however, how much that's going on, I think Matt says a lot, and I agree, it will be a lot, but it's not identified. But it's a very important point.
Yeah, the other thing I just wanted to ask was, when you think about lending to an individual, perhaps expectation is a bit strong, but the hope is that all of that money would be repaid because you're lending to someone an amount of money they can afford to repay. Obviously, with business lending, there's an inherent element of risk in the sense that some known proportion of businesses aren't going to work. Whether, that ice cream van might be an example. Maybe there's massive untapped demand and maybe there isn't. Does that change the way that credit unions think about lending in that situation versus lending to an individual? And is there something that credit unions offer in that, in that way of approaching that kind of loan, as opposed to, let's say, the way a bank might approach that kind of loan?
I can bring in Ravi to answer that question, if that's okay.
So the difficulty about lending to small businesses and small corporates is that assessing the risk. Because we are not assessing individual people, we are assessing a group, if you like. 1 in 3 businesses go out of business within 3 years. Small business, that is. So it's very difficult if you were to lend somebody, 30% of your money is not going to come back. It's a risk. Your members' money that you're lending out to people, you're not going to get back. So your interest rates on your loans have to go up quite substantially in order to kind of mitigate that. And I don't think we, as credit unions, we're not sophisticated enough. We don't have the technology to kind of assess businesses and different type of businesses. For example, a carpenter business or a builder or an ice cream man or whatever, different types. So it's very difficult to kind of get under one umbrella. This formula is going to work for everybody. It's not. So we need to become a bit more sophisticated, a bit more technology investment would help, I think.
Understood.
Paul wants to come in,
Yeah, just a little point on that. So you'll notice in my name here, we've got Liverpool, John Moores and Swoboda. And Swoboda is a research centre for bespoke research in the credit union sector in Ireland and Britain. And a few years ago, we did a paper on SME lending, but it's mostly in the Irish context. And one of the conclusions of that paper was that actually for credit unions, it's much safer to lend to existing businesses as corporate entities. And that's where the opportunities were to existing businesses who'd got a track record, who wanted to expand in some particular direction. Lending to startups was, in that paper, not recommended, because it was just much too riskier a business. Obviously, if you're lending to an individual who's buying a van as an individual loan, that's not the same thing. We're talking about lending to the corporate entity, and lending to startups in that paper was seen as maybe not the way to start. Existing businesses also have, financial needs, and that's the best place to go.
Interesting. Thanks very much. Thank you, Chair.
Thank you. Assemblymember Polanski, do you...
Yeah. Thank you. Morning, everyone. Matt, I accept that it's an emerging sector. And you also said there's the example in Manchester. Has there been any kind of conversations around decarbonisation? So some of these local businesses who will need to decarbonise or want to decarbonise, being able to lend money for that purpose?
So not specifically to my awareness in the business lending sector, but if I may just segue into other areas of green lending. There are examples emerging of credit unions that want to lend to households to make green transition, to retrofit homes. And indeed, we're in a conversation with the Department for Energy Net Zero currently around the role of credit unions to support that kind of lending. And because typically the loan values we're talking about are sort of £10,000 average, there's a lack of interest from some of the mainstream lenders. But actually for credit unions, given what we've already described about, this disproportionate focus on very small loans, which are hard to make sustainably pay on their own, it's actually a really big attractive opportunity for credit unions. And the national government wants to create a subsidised scheme to support lowering the interest rates on loans of that kind. And we're really keen as a sector to engage with that. We recognise that transition to cleaner energy in households and potentially for businesses too is something we need to do as a country, and we have a role to play in that. And if we can pioneer something, because some of the mainstream lenders are not as interested, that's great, and it's right in tune with our values and so on. And it's kind of, you know, Paul mentioned that point about thrift earlier, and I think there's a kind of modern interpretation of that concept of thrift, which is embedded in what credit unions are all about, which, you know, in the context of the green transition is, I think, quite relevant, you know, helping households to recognise the need to cut back on their energy use, transition to greener sources of energy and so on, I think would be a really nice way to modernise that thrift idea in the 21st century for credit unions. And so certainly something we're really keen to extend, and I think potentially there's a role for, you know, the Mayor and the London authorities to support that here in London. You know, because as I say, credit unions just want to lend money for ethical purposes, and those kinds of values are right where we want to be. So it makes loads of sense for us.
Can I just get a tiny bit of specificity on that last point? So in terms of the Mayor's role in this, I immediately jumped to an information campaign to know that this is a possibility for someone who's wanting to decarbonise their home or have cheaper bills.
Yeah, so I think it's about promotion, potentially about supporting, you know, with the guarantees and things like that, some financing. There's an example in Manchester where you know, the Greater Manchester Combined Authority is supporting credit unions there to do something similar, which is the area where this idea is emerging. So, you know, as a proud Mancunian, I'm hesitant to just keep pushing Manchester on you, of course. So, you know, it's not the only place, and it is a national initiative, and Paul could probably talk to some similar examples in Ireland. I'm familiar with schemes in the USA, where the federal government has supported credit unions to do something similar there too. The scale there is very much different, but I think it's right in the sweet spot of what credit unions should be about, and I think it's a big area for us to grow into over time.
Thank you. I'd say I'm a proud Manc too, but I might set people off. Thank you.
Assembly Member Wilson.
Thank you. So the question I was going to be asking is following on from the discussion about businesses and trying to understand what additional barriers there are for lending to business. Ravi, you've already mentioned, I think the key one being, particularly with startups, the risk of failure and therefore the risk of not getting your money back, and therefore the money that you do lend, you have to lend at a higher rate. Are there any other barriers, particularly Ravi and Ben, in your experience of running you know, the organisations that you do, any other barriers or hurdles to increasing that level of business lending that you could do?
As I said, we are used to be familiar with lending to individuals, but none of our underwriters or systems have the capability at the moment to assess business as a whole. So that would be a learning curve. We're not averse to it. You know, if the technology is available, we can do it. We would love to do it. But I think there needs to be an element of guarantee from somewhere, you know, in case a loan goes bad. But that might be from, I don't know, government or other institutions. But it's quite difficult, apart from that kind of hurdle. I can't think of anything else that might be.
I think it's a similar position from our side in that, you know, there is interest in this area, but it's not an area where we have the capacity or the current impetus. You know, we don't have underwriters who can read business plans. We don't have the expertise that we need to do here. And ultimately, the thing to remember with credit unions is that we're lending out existing members' money, and so it would be you know, probably outside of our risk appetite for us to be moving into that area using the existing capital that we have from our members. But we would be open to exploring whether that's something we want to do. But as Ravi said, that would be probably with an additional source of capital from elsewhere, and then also with support to enable the credit union sector to build the expertise. And I think, just to come back to one of the points that Matt raised, I think this is a really good example of an area where there could be, you know, there's opportunities for collaboration between credit unions through credit union service organisations, CUSOs. You know, this is a prime area where actually, you know, potentially with the Mayor's convening power, if this was an area that was a focus, there would be an opportunity to bring together credit unions to work out whether there would be an opportunity for London credit unions to work together to achieve the scale necessary to pilot this, to explore this further, and to, you know, do what it would take to get off the ground.
Yeah, just to reinforce Ben's point there, I think there's a collaborative opportunity here to invest collectively in that expertise. We don't currently have it, but we could get it. You know, it exists in the market. It's just about bringing it together. But most credit unions on their own couldn't sustain it. So I think a collaborative model with, as I say, opportunities through, for instance, the British Business Bank already offering guarantees to lenders to support the risk element of this. I do think there's an opportunity there. But it's not just limited to business lending. I think that collaborative approach, it could support credit unions to diversify their product range in a whole range of different areas and new credit markets. And that is a key part of our national strategy, and I hope that, you know, in one way or another, depending on the priorities here in London, that could be something we could work on here. And maybe that's in terms of business lending. I don't know.
Thank you. Assembly Member Polanski.
Thank you. Paul, if I can turn to you. We've talked about in the Chamber today how credit unions are often associated with supporting financially vulnerable people. Yes. How much is this perception, though, limiting credit unions being able to emerge into other sectors?
I think it's, yes, it is limiting. It was much more limiting in the past. Over the years of I've been doing research in this area for quite a number of years. It was very limiting in years gone by. I think things are beginning to change now, but one of the fundamental principles, the credit union success throughout the world internationally, we know that the credit unions, to succeed, do need to serve the financial needs of the population at large. Quite a number of years ago, the World Council of Credit Unions identified 7 doctrines of success in credit union development internationally, and that was the first one. That was the one. You know, you cannot be a bank just for the poor. And many people, many credit union sectors throughout the world, particularly in South America, learned that lesson the hard way. They had to diversify. And so our keeping this focus on financial inclusion is incredibly important. If you go onto the World Council of Credit Unions website, the first words you see at the bottom of the page are all about financial inclusion, even though credit unions throughout the world are serving the population at large. But there, at the heart of it, is serving people who are unserved by the for-profit commercial banking sector. But to do that, we need to serve the population at large. And so we've seen transformation in many of our credit unions, that the way that they offer their products and services, the way they come over to people. I mean, in my credit union, we don't ask people to save with us just to do social good over there. They can save with us and get as good a rate as in the as they can get from any bank anywhere. You know, not from the, and that's what we've got to do. I don't know if does that answer your question? I can't.
Yeah, no, it does answer my question. As time goes on, how do you make sure you keep the values, though, of, I accept I'm asking the opposite of the question I just asked now, but making sure that financial vulnerable people are at the heart of making sure they're protected too?
Keeping the values of the credit union sector, our cooperative values, is at the heart of the matter. And we do a lot of work with boards of directors, governance. It's the board responsibility to ensure that our credit unions maintain cooperative values. And those cooperative values are about serving the underserved, but they are also about democracy and engagement and participation, and actually doing, you know, it's about people helping people in communities. Keeping the values in the credit union sector is an incredibly important point. We have seen in other sectors throughout the world, historically, where they've lost their values and become just like commercial lenders. In other words, they've lost their soul, they've lost their raison d'etre, reason for being. You know, and that is, there was a guy at the Open University wrote a book on it and called it the degeneration thesis, where cooperatives degenerate into be looking just like for-profit sectors. So keeping our focus on our values is a core issue, and it's what, you know, ABCOL or the Trade Association, boards of directors have to keep an eye on all of the time and ask them questions. You know, are we doing what we're designed to do? Our purpose. Just the purpose. don't know, does that answer your question?
Yeah, I think a final follow-up is, other than them looking to keep an eye on it, is there an audit process or a kind of mechanism to ensure those values?
Really interesting question. Increasingly an audit process in a sense. It's a voluntary audit process for the moment in Britain. Of course, we've all had to audit ourselves financially, our financial statements. But more and more credit unions are doing social audits now. It is an area of development. We've done some papers on it in years gone by. My own credit union did a social audit, and all the credit unions in Liverpool did a social audit to reveal and to identify what actually they were achieving in communities and whether that was actually in line with their values and actually engaging. There's various ways you can do it, but social auditing is becoming much more important, and but it is voluntary at the moment for credit unions to do it.
Thank you very much. Ben.
Can I just come in? I just would like to know who would do a social audit. Have you got any ideas about that, Paul?
I thought you were asking me then.
Yeah, well, we've been writing a system for this for quite a few years, and we're trying to bring it. We're trying to bring out a new paper on it. I mean, really, for it to work well, it needs to be done regularly. Maybe not every year, but every 2 years, to see trends of how things are going. We want to build a system whereby credit unions can do this themselves. But in some of the examples that we've had in recent years, they've engaged external consultants or external agencies to actually undertake that for the credit union. The one that we did in Liverpool was undertaken by an external consultant, and there are quite a number of people who are able to do this. But really where we want to get to is where a credit union can do it themselves through their own capture of data as they go through, they'll go through the year. But Fair for All has also supported one or two, I think, social audits in credit unions, and and we've also got the same process going on in Ireland, in the Republic of Ireland. Some credit unions there have done some really good social audit reports.
Okay, so there are examples, yeah.
Yeah, there's quite a number of examples around. You can Google and find them on the internet of social audits of credit unions. But it is an emerging area. But in terms of identifying, and we asked at the very beginning, what's the difference between a credit union and a bank? Actually, prove it. We can talk about it, but you have to prove it. This is what we say to our members now, to our credit union members now. We can say it, but prove it. And the social audit, the social auditing process, the social impact reporting is one way of proving, what we say to be true.
Ben and Ravi would like to come in.
So we ourselves are midpoint through our own social impact process at the moment. I think it's fair to say that, like the rest of the credit union sector, we're on a bit of a journey in terms of how we can systematise that and perhaps make it more methodologically sound and consistent than it has been in the past. And I think there's a big role for external expertise, and I think we welcome calls to be more rigorous in how we are monitoring and reporting on social impact. I think for us as a credit union personally, when the FCA introduced the consumer duty, a lot of the financial services industries, it was caused a great amount of fuss because in many cases it was a challenge to their business models. Actually, in our case, the requirement that introduced by the FCA to measure and report and evidence on positive outcomes for our members, that was actually a welcome challenge to us, because actually it was an opportunity for us to become much more rigorous and systematic in measuring the social impact, which we already knew was at the heart of our business. So I think that's a really important part of what we do. I think, just to come back to the previous aspect of your question, though, in terms of that challenge, in terms of that conflict between scale and values, I think that, and Paul will be able to add on this, but I think, there is a tension there, but it doesn't have to be a trade-off, because actually what we see internationally with some of the most successful credit unions, and I think one of the sources of inspiration for ourselves is Van City in Canada, where you've got a very large regionally based credit union serving the whole of Vancouver, an entire region of Canada, where multiple branches, very sophisticated operation, offering a full range of financial services, but where their social mission and their social purpose is absolutely at the heart of their brand. And I think we see that that in the UK as well, that the most successful credit unions, rather than social impact and being a kind of an add-on or a nice to have or bolted on as a kind of an ESG element, it's where they're using the social impact and communicating that social impact to their members as their engine of growth. And I think in terms of where social attitudes are at in terms of people's expectations of financial institutions, credit unions, if they can be more systematic and more rigorous in measuring and reporting on that social impact and making it a central part of their message, I think that is that's not in tension with growth and scale. That's how we get the growth and the scale.
Here's one more we met earlier. It's been a rather laborious task, I must say. Board members, staff time. We had an intern, luckily, who did we did the survey of all the members, collected all the data and put it all through, and the intern was very helpful and put it all together. It is quite hard work. If we were to hire somebody externally, thousands of pounds, and we wouldn't be able to afford it normally. So, statistics from, what members think of us, how we've impacted their lives, and that kind of good stories and things like that in it. You're welcome to have a copy. It's on our website as well.
I just wanted to come in with a slightly more sort of historical and perhaps philosophical point about the role of cooperatives and mutuals in this space. So there's a broader, credit unions are part of a cooperative and mutual economy, which is broader than just what we do. There are building societies, financial mutuals and co-ops in all sorts of different sectors, energy, for instance. And we've got a proud tradition of creating markets with our sector. So, in the 19th century, it was building societies that created what we now know as the sort of home owning democracy of the UK, gave home ownership and the possibility of that to ordinary people, and have been hugely successful in that process. Likewise with friendly societies and mutual insurers, giving people protection, when the worst should happen, ill health, accidents at work and so on, which has become this multi-billion-pound industry of insurance that we know today. And of course, at the very end of that process, then a lot of those institutions sadly demutualised and became private institutions. And I think credit unions are playing a similar role here today. We talked already about payroll savings. Credit unions have really pioneered something in terms of saving in the workplace, which I think has the potential to become a mass market product. And we're already actually seeing fintechs and other private interests coming into that space, seeing what credit unions have done and seeing the profit opportunity that's there. So whilst I don't disagree that social impact is an important thing, I think we're at the other end of that spectrum. We're a long way from being, the huge institutions that have the pressure to demutualise. It's in the very DNA of our organisation still, and we're all very close. Even the largest credit unions still very close to their members relative to Nationwide Building Society, for instance. And so, I don't, think that social impact is. I don't want to sort of suggest it's not an important thing for us to do, but I do think, we shouldn't overplay that where we are in our development as a sector in this country. I think we could all easily demonstrate through the stories of our members the impact we're having, and we want to create a new opportunity for a way of delivering services in the country.
Thank you. Assembly Member Garrett.
Thanks. I suppose connecting together some of the threads that we've covered already, what are the main obstacles, would you say, to credit unions kind of both growing their existing membership and expanding their activity and reach, particularly in London? Don't know what to kick off.
Best we like. Simply said, resources. So we are not as resourceful as fintech banks, for example, or the new fangled banks that are coming to IPOs and what have you. We are very limited. Obviously, the money we make is through the loans. That's the only product we do. And we service our officers, pay staff, offset bad debts, etc., and we manage and pay a dividend. It's quite hard. So any support from any other sources, advertising, promotion, payroll deduction, like all the areas we've already covered, And any promotion in any shape or form, you know, TfL, thousands of buses, we could have a few with credit union promoted. I don't know. You know, it's an idea. So anything in that area would be helpful.
I think from our perspective, the biggest barrier is in terms of perception. You know, at its most successful, the credit union model is based on having that socially diverse membership that we've already talked about. In an ideal world, you would have hundreds of thousands of NHS employees, local authority employees, TfL staff, you know, anchor institutions all across London, where those, you know, from the lowest paid to the most moderate income employees are members of a credit union. They're borrowing, you know, a reasonable rates, they're saving regularly, they're getting a service through their employer which is beneficial to them. But by serving a huge number of those people and achieving scale in those areas, that's generating the income that credit unions need in order to be financially self-sufficient and to help to support our higher cost, higher risk work in the community in all the ways we've talked about, supporting the kind of the most vulnerable members. Because the reality is that the fact that we're a mutual, the fact that we're credit unions, doesn't mean that those segments of the community aren't incredibly expensive to save in terms of servicing costs, in terms of you know, lending risk. The costs there are real, and so therefore we need to have that breadth of membership in order for that element of cross subsidy or that element of solidarity to work. And so I think, you know, our biggest ask would be ensuring that there is that understanding there of the importance of credit unions, that permission almost from policymakers and from political leaders to that actually it's okay for a credit union to be competing in the mainstream market. There's nothing wrong with that, and that is not a distraction from our underlying social purpose. That's how we make the business model work. So I guess the key ask and the key message from us here would be understanding the importance of that breadth of membership and helping to open the doors and create the opportunities for us to make sure that we're able to maintain that breadth of membership through payroll deduction relationships with anchor institutions across London.
Thank you.
Apologies, I can't see remotely who's indicating, so hopefully the chair can...
So Matt would like to come in.
Yeah, thank you. So I guess at the national level, I mentioned already, we published this credit union growth plan for the benefit of the online member there. I should wave it at the camera. So there are a number of barriers there that we want to address in terms of regulation, legislation. I mentioned Common Bond earlier. You know, as Ravi said, investment and resources are a key issue for scaling any organisation. And we're excited about the opportunity with the Fair for All Finance Credit Union Transformation Fund investment, £30 million nationally, that's going to, at the England level at least, that's going to be invested into growing the credit union sector. One of the themes within what we expect to emerge from that fund, and we're at the early stages of what's developing there, is about linking the national agenda through the Transformation Fund managed by Fair for All Finance with opportunities in the devolved administrations, like in London and elsewhere, the city regions, and so on. Because, you know, leveraging the reach of devolved administrations to support the national agenda around credit union transformation will only magnify our success. And we've got a number of emerging collaborative efforts in Greater Manchester, in Merseyside, in West Yorkshire and the Midlands, and here in London as well, of credit unions coming together to collaborate and invest together and getting that scale that we mentioned earlier through CUSOs and the like. So I think if you know, the Mayor and the Assembly could lend its weight to that effort, you know, and contribute in London to the national agenda around transforming credit union reach, then that would be really exciting. You know, what exactly that means in every area, in every case, you know, is to be determined, but it's about, you know, being engaged with that process and supporting us to achieve what we can for Londoners and elsewhere.
And Paul.
Thanks.
Yeah, at the moment at Swoboda, we're doing actually a national research project called United Vision. It's about the future of the credit union sector. It's not just about London, but includes London. And just for interest, I thought I'd share one or two of the key reasons why Our credit union people feel that the sector is what's holding us back, what's holding the sector back. We did a national survey just before Christmas, and we had about 260 credit union leaders throughout the country replied, including people from London. And just the headlines, I mean, all the things that Matt said are true already, but just some of the headlines. One, as what we've already said a lot today, is about invisibility. Credit unions, are generally invisible. And where we look at successful credit union leagues or movements throughout the world, they are much more successful in branding and in promotion, and the community, the population knowing what they are when they, when they're mentioned. The other one, though, I'll mention just 4 top ones. The other one was all about leadership and governance. To move a sector forward, you need entrepreneurial leadership. And there's a lot of effort being put in now in the credit union sector through ABCUL, other organisations, in developing the skills and abilities of credit union leaders, both CEOs and boards of directors, to take this movement forward. But it's essential. That's what came back from our survey. What's holding us back is, still issues around entrepreneurial leadership and governance. Another one high on the agenda is still about technology. We've spoken about the kind of improvements in technology in recent years, and it's true. Most of our credit unions now have apps, and we can move our money around on the computer, but the technology isn't matching the competition. Matt referred to this. We are where we are, but technology needs even to be better and more advanced, particularly with the introduction of AI. So that was another one. And then the 4th one, which I'll mention, which is not me mentioning it, it's what they told us, is the lack of capital within the sector to invest and support rapid growth. It's a big issue, and we're doing a paper with the New Economics Foundation at the moment on capital within the sector. And, there just isn't the funds there to invest in technology and awareness seriously at the level that's really required. So identifying capital investment is going to be a big issue. There were other points, but Matt's mentioned most of them, but I just thought I'd pick up 4 of them that came back from that survey.
Thanks, Chair. It does sound like capital is the big sort of hurdle, doesn't it?
Yeah.
Thanks, everyone. Thanks, Chair.
Thank you. Assemblymember Georgie.
Thank you, Chair. Matt, you've referenced this earlier, but community banking is generally more developed in other countries, such as the US or Ireland. What key lessons can the UK learn from other countries or regions in the UK?
So it is, as you've said, so in Ireland, for instance, something like 3/4 of the population are members of a credit union, and, we often look enviously at their statistics. Here in the UK. In the US, I think it's more like 40%, and they're leaders in markets like car finance. And I guess that sort of points to one of the key lessons, I think, which is about the range of products and services credit unions can offer here relative to those other places. Certainly in the US, where, we're limited, generally speaking, to savings and loan services, but we need to offer a broader range of products and services in order to be relevant to more people and to more markets. London Mutual Ben's Credit Union is a great example of a credit union that's pioneered some of this. They're offering a full current account service, for example, and overdrafts, and they developed years ago a competitor product to the payday loan product that was very popular, Wonga in particular. Of course, ethically structured and interest rates and so on. But there's a whole range of other things we could do, credit cards, car finance, both markets where we've seen the mainstream actually rip consumers off in recent years. The car finance scandals still ongoing. Credit cards, I think, actually is still below the radar largely, but there's millions of people in problem debt with credit cards, and I think there's a role for credit unions offering a more ethical alternative to that. Mortgages, I've mentioned as well, credit unions like Ben's are offering, but in a small way, and we think that there are opportunities to expand that. All of that, I think, would need investment in collaborative solutions, though. It's unlikely that many credit unions, other than the very largest, would be able to sustain the resources independently to support an entry into a market like credit cards, for example. So CUSOs and collaborative solutions to some of those things are definitely part of the picture. And again, that's a common feature in the US in particular, where credit unions are a much more prominent part of the landscape. There's a whole range of other things that factors that are historical or specific to the jurisdictions that explain why credit unions are so much larger in Ireland, for example, or the US, which I don't think are easy to replicate. For instance, the mortgage market in the US, very small institutions can participate in mortgage lending through securitization, through the institutions that became infamous in the banking crisis, Fannie Mae, Freddie Mac. As a small credit union, you can write mortgages and sell them on and keep writing, and you don't block up your relatively small balance sheet. Some of that, I don't think the London Assembly has the powers to change, but it's worth being aware of. Another is in terms of banking, and if you want to offer a banking service as a current account in this country as a small institution, you don't have any access to the interchange fee revenue that the large banks do that make that sustainable on a broadly free basis. And so you're at an immediate competitive disadvantage. In the USA, that's different. Credit unions get a fair share of that interchange revenue, which enables them to do some of the things that we don't do here. So there are some significant structural barriers to some of those things here. But ultimately, I think it's about trying to offer a full range of retail banking services so that we can do, as Paul said, and serve the whole of our community and have something that's relevant to everyone, rather than being pigeonholed as a thing for a marginalised group in society.
I mean, I'm not sure Fannie Mae and Freddie Mac is probably the best example that you could have given, for the simple reason that we're talking two large organisations, which obviously contribute to the problem. I think my question is more relating to, as I drive around America, you go into these small towns and you'll drive like these random towns and you'll see like 6 independent community banks. Like, it's insane. But then when you visit my cousins, and I'll be like, what's that about? Does anyone actually use that rather than your big boys, whatever banks down? They're like, yeah. I think you said, like, my mortgage is with them. And it's crazy.
Yeah, but I mean, I think I appreciate Fannie Mae, Freddie Mac have internationally got a poor reputation because of their association with the banking crisis. But actually, they were institutions established by the federal government in the US in order to extend affordable mortgage credit to marginalised communities in the US. And there's something called the Community Reinvestment Act, which also supported that, which we don't have an equivalent of here. So, despite the baggage that they've got because of the crisis, they're actually still playing a vital role in extending credit through small institutions in the US.
I think that's a fair point. I think that where you say you can't replicate what the Americans do in the UK, I think it's probably right. Number one, because you've got higher incomes, therefore more cash and liquidity in the market, and therefore these banks can take on more customers because there's more money swilling around than there is in the UK. I mean, that's just a fact.
Well, I think it's about structurally. So the UK is very focused on the City of London, which is dominant in the UK economy, of course, and has extreme levels of influence over government policy. And I think I would say that the concentration of banking services in the UK is not an inevitability. It's been a policy choice that's been made over decades. We did have regional banks. We had regional building societies. And, since the 70s and 80s, it's been a process that the national government has encouraged for privatisation, demutualisation and agglomeration of banking institutions. And that's why we've got no regional banks left. But, I'm not saying, that's not a process that's easily reversed, but it isn't true to say that, the UK never had that stuff. It's just we said goodbye to it in order to facilitate the interests of the city.
Yeah, I mean, you're a witness and a guest, so therefore I'm not going to get into... I disagree with much of that, but having said that, I think we're focusing too much on Ireland and America Whereas, you know, some of my colleagues with different ideological opinions might look at a more German model, you know, where you have greater integration. And I appreciate that there's sort of a hybrid model between state and local. But I think Germany, you know, once again, I went on a site visit and you had, you know, these literally town banks, you know, which just served the town, worked with local government.
Yeah, but I'll make the point again. We had that in the UK as well, and it was allowed to go by a process of national policy, which was about privatisation, demutualisation, agglomeration of bank institutions. So that did exist here as well, and the German example's a good one because the German state has made a decision to preserve that in their context, which we didn't make politically. Now, that's very hard to reverse, but I do think the lesson that we've got in this for credit unions now in this country is that we need to support credit unions to diversify and offer that range of services that would enable us to be more relevant to more people, and that's going to have to be done differently in this context because of some of those changes.
Well, but this is the point that I'm making, right? So just because something has happened in the past which your industry may disagree with, that doesn't prevent you from lobbying for something that you do agree with today. For example, you know, we know that interest rates are comparatively low in the UK compared to America, let's say, where, you know, they're 6-7% or whatever it is, you know, here comparatively low, but younger people still can't get on the housing ladder. You know, bigger banks are prohibitive in the loans that they offer, so therefore credit unions, regional banks in the future could step in, working with the state and offering competitive rates to get people onto the housing ladder. So this is the point that I'm making, is that people may disagree what's happened before. That doesn't mean the state must therefore prohibit what happens in the future.
No, I don't, but it would imply a significant shift in policy in relation to the City of London, and I think that's a very big political question that, you know, I don't perceive the current government has a will to take on. You know, so there is a campaign in this country, for example, currently for a Fair Banking Act, which would be similar to a Community Reinvestment Act in the US. And that would imply a requirement on banks to invest in community institutions like credit unions, to provide services in communities that they're not serving. But there's no political will for that currently. That's the national level, that's the truth. Yeah. But you would need that kind of interventionist policy to recreate regional banking in the way that it exists in other parts of the world, I think. You know, I'm realistic about the prospects of that, but you know, I think it's just a historical fact to say that that's.
So Paul would like to come in if you're willing to.
Yeah. I think, though, what I'd like to come in about, I think we've lost the drift of that in the conversation just now, so I'm kind of backtracking a little bit. It was all about, we're talking about what we can learn from other jurisdictions, and people mentioned Ireland. And I just wanted to just share one big learning curve that or learning output from Ireland in recent years. As Matt says, credit unions are embedded in communities and towns throughout Ireland. You just drive around Ireland, you will see credit unions everywhere. They are the most trusted commercial entity in Ireland through an independent research. Every year they become the most trusted entity. They are part and parcel of the community in a way they're not in Britain. But in 2017, we wrote a report, and it said, is the Irish credit union business model, is it still fit for purpose? And it wasn't, because Irish credit unions were beginning to fail. They were still the most trusted organisation, but they weren't lending any money. They weren't lending enough money. Loan-to-asset ratio was less than 20%. They were stuck, and they were heading to a very difficult place. But then, here's the learning curve. They transformed. They began to transform by really relooking and restructuring their business model. They had new enabling legislation from the Irish government in 2023, and which enabled much wider development of the loan portfolio. They moved into mortgages, which are now 10% of the loan business. They moved into green lending, agricultural loans, investing in social housing, and last year their loan increase in 2024 was 12%, up to 7.1 billion. So they've still got a way to go, but they are on a trajectory to becoming a much more established than they are, back to how they were established years ago, and in solidifying their sector. And that's the learning curve really for us. You know, for taking our movement forward, we also need to restructure our business model. All the issues that have been mentioned about products and services and digitalisation, the way that we engage with members. And this is the big issue, and this is what's kind of exemplified in the strategy for growth that Matt's spoken about. So the learning curve is you can transform a movement and take it forward. And I've got other international examples as well, which are on the same theme, that you actually can take a movement forward significantly.
Thank you. And Ben, did you have anything to add to that?
I just wanted to add, in terms of the regulatory outlook in the UK compared to other countries, I think, you know, in the UK, the Credit Unions Act is pretty tightly defined. You know, it treats a commercial for-profit model as the default, and credit unions effectively as a carve-out from that. And so the range of activities that credit unions are able to carry out on behalf of their members is specified in that act and is restricted to that. I think if you, and if you speak to, the tone, from the experience of a credit union ourselves, the tone we often get for regulators is, credit unions as the sort of, strange anomaly in the system, and very much kind of expected to justify our business model, and it contrasts against the kind of the mainstream. And I think it's interesting when you compare that to the outlook when we've interacted with American regulators. Actually, it's a much more empowering and permissive regulatory outlook and amongst policymakers there, because as I think everyone's touched on here, it's much more about seeing credit unions, rather than being a carve out from the financial norm, from the default, they are seen as a kind of an instrumental and indispensable part of the financial system in terms of driving productivity, driving economic inclusion at the macro level. So rather than being seen as the sort of, the problem child of the community and voluntary sector, they are seen as one of the ways in which the federal government and state governments enable financial inclusion and drive economic, there's an appreciation of the role that they play in the macroeconomic system, and the regulation and the attitudes of regulators and policymakers reflect that mission in a way that at the moment they simply don't in the UK.
Yeah, just one comment, if I may. I think that actually perfectly encapsulates it, because, to my mind, when I hear the phrase credit union, I just think of a bunch of do-gooders that, all nice and moralistic, but really what you are, because, as all Assembly members are diligent in their research, is effectively you are a nimble arm of the financial market. You are able to act quickly and efficiently and be able to support those that don't have the means to go to others. So I think if there's one thing that comes out of this, it goes to your point, Ben. I think you've encapsulated the best, which is effectively don't treat us as the crazy cousin. Treat us as effectively a sustainable part of the market. Going back to Matt's point, that can be improved. Going back to Paul's point, that legislators need to look more closely at and see how we expand the offer in the market.
I think we all need to aim a bit higher.
Yeah.
If I may, just to end on a positive note, I mean, I think that we have a government now is saying it wants to double the size of the cooperative and mutual economy. We have a financial inclusion strategy that's allocated, a not insignificant amount of money to invest in the kinds of things we want to do. A regulator that just reported in December on ways in which it can alleviate regulation to support the expansion of co-ops and mutuals and credit unions included in that. So we do have a moment of opportunity right now. And I think, the London Assembly, the Mayor and so on could support that, as in the way that we talked about earlier, in terms of aligning with the transformation investment that we anticipate coming down the line soon. And hopefully we can be more like the credit unions in the US and Ireland and elsewhere, and transform ourselves too, because I think the need is clear in society for what we can offer, many millions of people being underserved.
Thank you. For a moment there, I thought Assembly Member Georgie was going to start saying this is woke banking, that. Our last question will be from Assembly Member Ahmed.
Thank you, Chair, and my apologies for my lateness this morning. Good morning, panel. I want to talk to you more about what you think the Mayor can actually do to promote and support community banks in London. Now, I've heard you, so when Assembly Member Desai spoke about the SMEs, you talked about what could be done there, and throughout you've talked about how the credit union and the reach of the credit unions could be further promoted by the Mayor. I'm going to ask you all, and just wait for you to just come in, I'm not going to pinpoint anyone, what more can be done by the Mayor to support community banks, particularly when we look at the agenda and the priority of the Mayor in terms of growth in London? So over to you, who'd like to start? Ben?
I'm happy to take that one first. I think, when you look at the interventions made by the Mayor so far, you can get a good idea of what works. So I think, one of the things which has happened under this Mayor is the expansion of payroll services to Transport for London. That means that hundreds of members of Transport for London are able to become members of a credit union, but it also is a way of supporting the credit union sector more widely in terms of our access to some of the most vulnerable communities in London. So I think, for us, a big ask would be for the Mayor to use their convening power. And I think, there is huge convening power from City Hall to bring together credit unions and businesses and anchor institutions and public sector bodies across London to help them to understand how, by partnering with a local credit union, they can improve the financial well-being and financial resilience of their own staff, whilst also contributing to the economic success of the communities they work in. And it's very much that community wealth-building model there in action. There's a really concrete example of that. And I think we also saw the mayoral leadership in terms of the Good Work Standard, inclusion of credit unions within that. I think that's another great example of the way in which actually the Mayor can use their platform in terms of setting out best practice to show how credit unions are part of that best practice. And so, ways in which that could be extended. I can think of the housing associations that the GLA works with and in some cases supports. Could working in collaboration with the local credit union to benefit tenants and their staff, could that be part of the social value in the procurement process when working with housing associations and other providers and suppliers? Thinking about ways in which social value acts may be used and involvement with credit unions can be tied through some of the procurement that takes place in City Hall, I guess would be another big opportunity. And then I guess the third and final one would be, as we've touched on a lot, I think a lot of the barriers to the growth of credit unions is scale, and I think that one of the ways which that scale can be unlocked is greater collaboration between credit unions in London. For a whole range of kind of reasons and historical reasons, that hasn't happened in a way that it should be. And so again, is there an opportunity for the Mayor to use their convening power to bring together all of those different players and people that are part of that community banking landscape in London to say how can we create a more holistic offer that benefits people across London, and how can we try and even out some of the fragmentation that exists there in terms of what they're able to offer and what they're able to do, and how could you use their combined scale to do even more?
Thank you. And you touched on my next question, though, which actually is about the Good Work Standard. So hold that thought. Would anybody else like to come in on what more the Mayor could do? Ravi?
I'll just say to all the things that Matt and Ben and Paul have said. Promotion, essentially. Promotion with all the partners that you work with to encourage them to, promote payroll deduction, payroll savings through, their salaries, for example. That would be a huge step, because I'm sure you have millions of people employed by these organisations across London, working in all various capacities. And as a kind of a sweetener, if you like, that would be amazing if the Mayor could do that. And I mean, the way I look at our credit union is almost we are like the casualty of the financial world. People come to us as a last resort often. And that is not recognised, I don't think. And so the importance of how we support the community is quite important. How that could be supported through councillors, mayors, assembly, whatever, that would be very helpful too.
Okay, thank you. Matt, did you want to say anything else?
Yeah, I mean, just to reinforce the message I gave earlier, I mean, Ravi and Ben are here in London working every day, so they can best describe some of the sort of more practical, ground level things that I think the Mayor can do. But I think at the national level, we have this opportunity with the investment that's coming. And a key focus, as I've already said, of that is going to be how does that investment leverage off the devolved administrations, and that include the GLA and the London Mayor in that, and that's all the sorts of things that Ben describes. But as part of a national approach to how do we transform credit unions across the country, could be really powerful. Because there may be investments in, for example, CUSO approach that we've described that isn't necessarily here in London but has benefits for credit unions here in London. There's one that I'm familiar with, for example, supporting credit unions to enter the car finance space, and I think that's an opportunity for growth, an opportunity for more ethical services. Londoners need access to affordable transport, and so on. The green agenda, the mortgages we've talked about, where these collaborative solutions are like, we want them to emerge. They won't all necessarily be here in London, but they'll benefit London credit unions and Londoners by extension. And so I hope that we can, have access to people within GLA who can engage with that national process and then link into the credit unions here in London to ensure that it has the maximum impact for Londoners as well as elsewhere in the country, and that's our ambition.
Thank you. And Paul, did you want to say anything?
Yes, I'd focus on two main areas. I mean, there's lots of areas, but I'd focus on the two main areas which have been mentioned already by everybody, but just to kind of clarify them. One is visibility. We mentioned the invisible nature of credit unions. Visibility. The Mayor could do so much to, make credit unions much more known in London through partnerships, through endorsement, through encouraging public sector and private sector organisations to develop payroll deduction. There's a lot to be done in terms of visibility. And the next one is a lot to be done in terms of collaboration, as Ben has mentioned. When we look around the world at different successful movements, whether it's in South America, North America, anywhere in Africa, collaboration, it's where credit unions actually come together to collaborate, to develop the credit union service organisations that Matt's mentioned, to develop joint products and services and develop joint branding, so that throughout London, it's clear what a credit union is. Is it a credit union? Is it a community bank? Is it something else? You need very clear branding so people can see immediately that the credit union in one part of London is the same as in the credit union in another part of London. So I would stress those two, because the visibility and the power you have as a catalyst to bring organisations together. And I think bringing the credit unions together in much more collaborative ways forward would really be, would be very valuable. So those are my two areas, visibility and collaboration.
Thank you very much. And my final question is about the Mayor's Good Work Standard. So we've heard that credit unions provide financial services so we've heard that the Mayor's Good Work Standard works with local credit unions to provide financial services to its employees. What extent do you believe that including this element in the Good Work Standards has been effective in expanding the sector in London, and what more can be done? Ben, I can see you bursting to say something there.
I think it's a really good example of the way in which actually the Mayor can use the tools at their disposal to promote and create a platform for credit unions. We've had a number of employers approach us about working with us to provide services to their staff, and the only reason they were aware that we existed and that it was a good thing to do is because they were reviewing the criteria within the Mayor's Good Work Standard, and they got to the item on the list and they said, well, what's this about working with a credit union? And then the conversation starts from there. So, that's a good example of one of the ways in which the Mayor can say working with a credit union is a good thing to do. the GLA expects, companies that we work with to be doing this stuff and really showing leadership and setting the way. And I think the fact that the Mayor and the GLA are already doing that in terms of, we partner with the GLA to offer salary deducted savings and loans to all GLA as well as TfL staff. We'd love to see that expanded to other bodies under the Mayor's oversight. But then beyond that, there's a huge number of opportunities with NHS trusts, with as I say, the rest of the public sector, but then also with small and medium-sized businesses. It doesn't cost anything to partner with a local credit union. It's a popular perk for staff being able to access, affordable loans and save regularly from their salary. And as I say, the income and the revenue and the growth that we get from working with those public sector employers and their small businesses, that's the secret sauce that enables us to sustain our work with some of the most vulnerable in the community. So again, I sound like a broken record here, but if there's one message that it would be great to take from today, it is that you need to get that virtuous cycle going in terms of serving a broad reach of the community.
Thank you. Anybody else?
Maybe just to add and repeat the point I made earlier on about opt-out payroll savings, I think it's a transformational idea for a really pernicious problem that many people suffer through lack of financial resilience, through lack of saving. It has the potential to be transformational in that space, as well as transformation in the reach of credit unions more generally, to all of the points Ben's made so eloquently already. So I think, it's something really profound that the Mayor could do would be to back the provision of auto-enrolment payroll savings in London. It would be a big thing to do, I recognise that, but it would be a bold move and one that would show the way for the national agenda around savings, which is a real crisis.
Okay, all right. I think we're done there.
Thank you very much.
Thank you.
Thank you. We've now reached the end of the session. I'd like to thank our guests for attending this meeting and for all their contributions today. You really have made it very clear that you're the heart and soul of banking, and hopefully our work and our committee report will do some of that work that you're asking for that promotion, for the need of that public awareness and that collaboration. The committee has got a few more brief items of business to deal with. I kindly ask our guests if you can just remain seated just for a short amount of time while I just go through the proceedings. It won't take long, I promise. Thank you. Can I ask the committee to note the report and the discussion? Thank you. Can we also delegate authority to me as chair in consultation with party group lead members to agree any output arising from this discussion? Thank you. Can I ask the committee to note the work programme and the additional activity undertaken on the 12th of January 2026, namely the informal roundtable session with guests who had lived experience as unpaid carers in London? And the next meeting of the committee will be held on 3rd of March 2026 at 3 o'clock in the committee rooms of 2 and 3 at City Hall. I have no urgent business, which concludes today's meeting. Thank you.
This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast